Welcome, dear traders. You are watching a recap of the Asian session. After reversal on Wall Street last Friday, stocks kicked off the new week with a decline due to cautious sentiment. Tech stocks in Japan and Australia incurred the biggest losses. The S&P NZX 50 experienced the largest drop, falling to a 4-week low. Trading in stock markets in August is usually rather lackadaisical. This is why one of the reasons for a decrease in stocks could be profit-taking before the holiday season. Yet, the main catalyst for the bearish sentiment was the US non-farm payrolls report. As in many other recent reports, payrolls for July turned out to be mixed as well, and the economy added 187,000 new jobs instead of the consensus reading of 190 and 200,000 jobs. Notably, this was the lowest prediction for the non-farm payrolls report. At the same time, the unemployment rate unexpectedly fell. A decline in the number of employees should have led to an increase in unemployment. Wage growth in July amounted to 4.4%, and the indicator has remained unchanged for the fourth month in a row. Inflation is stubbornly higher than the 2% target, contrary to forecasts. The probability of another rate hike has increased significantly. Hawkish expectations were fueled by comments from a Fed Governor, Bowman. We should remain willing to raise the federal funds rate at a future meeting if the incoming data indicate that progress on inflation has stalled, she pointed out. Atlanta Fed President Raphael Bostic admitted the likelihood that the aggressive tightening may continue until 2024, and there will be 3 more meetings this year on September 20, November 1st, and December 13th. Despite such hawkish remarks, investors evaluate the near-term prospects somewhat differently. According to the FEDWATCH tool, only 13.5% of speculators have factored in a rate hike at the September meeting. The US dollar was moving up for some time amid hawkish expectations. Besides, strong economic reports helped the greenback at more than 2% since mid-July. Yet, lots of fresh reports confused traders. The US dollar index is hovering near its lowest levels since the start of the year. After the controversial employment report, the US dollar fell quite sharply, almost losing its entire weekly growth. After a period of increased volatility last week, the greenback stabilized on a Monday. In the Asian session, it was moving in the range of 101.90 and 102.30. Its upside potential looks limited now, as investors are anticipating inflation data, which is on tap on Wednesday. It's a sure to fact the trajectory of the US dollar, as the consumer prices may not be in line with the forecasts. It's extremely difficult to say what to expect from the US dollar. It may rebound and rise even higher. In this case, the March high of 106 will serve as a key technical level. A breakout of this resistance level will increase the chances of a further growth. Despite a strong rise in the US dollar and the yield of Treasury notes, the dollar-yen pair has been trading at the lower levels since last Friday. It's moving in the range of 141.50 and 142.40. To some extent, it was facilitated by the Bank of Japan minutes published today. They showed that the regulator may conduct yield curve control with greater flexibility regarding the upper and lower bounds of the range as references. In the Asian session, the pair was trading at 141.30 following those remarks. Last week, too, unscheduled bond buying operations by the Bank of Japan and dovish comments by policymakers pushed the yen to new highs. As for interventions on the forex, Japan has not taken such steps in the first half of 2023. It intervened in the foreign exchange market in October 2022. Back then, it spent 6.35 trillion to support the national currency. So far, the yen is holding far from the key levels of the last year. Nevertheless, the dollar-yen pair needs to break below the support level of 141.25. It will signal the end of the upward movement. The Australian dollar reached 0.6567, yet it's still far from the peaks of last Friday. It appreciated mostly because of rising oil prices, which jumped to a 4-month high. However, there are plenty of negative factors for commodity currencies. For example, risk aversion, a rally of the US dollar, opposing the tightening cycle by the Reserve Bank of Australia, and the weak economic recovery of China. The Aussie is consolidating in the range of 0.6558 and 0.6595 in anticipation of fresh US data and other news. The New Zealand dollar is now moving in the channel of 0.6087 and 0.6115. The Kiwi dollar pair hit 0.6115, but later it declined below the support level. It was trading at 0.6097 at the end of the Asian session. And that's all for now. Hit the subscribe button and keep close tabs on the market developments with us. See you soon!